So what's a readvanceable mortgage? Well, basically, it's like a mortgage where you pay your interest and principal, but the only difference is whenever you pay down your principal portion, the bank will automatically issue you a line of credit for whatever principal portion that you pay down. So what that would mean is you have the opportunity to pay your interest and principal, but you can actually take your principal back that you paid down in a form of a line of credit, leaving you with an interest-only payment at 3% or 3.19 versus a line of credit which issues out at 3.5% or 4. So let's go through an example. We have a $400,000 mortgage at 3.19%. You pay $1,727 a month. The interest on that mortgage is $1,063. The principal portion is $663. So whenever this person would pay down the mortgage by $663, a line of credit would be issued for the same amount. So let's say, for example, on June 1st, we paid the $1,727. Automatically, a line of credit would be issued to us for the $663. If we chose to, we could take the $663 and put it back into our bank account. And because this is a line of credit, we have to pay interest on that line of credit. So if we're taking out $663 at 4% or 3.5%, depending on what rate you get, you're looking at about $24 or $23 per year worth of interest. Divide that by 12, and in this scenario, it's $1.93 worth of interest. So the person's total net payment becomes $1,064.93. Let's go to July 1st. Again, we pay the $1,727. The $663 gets issued to us in form of a line of credit. If we chose to, we take out the $663, put it back into our bank account. Because this is a line of credit, we now owe $1,326 total. At 3.5% or 4%, our monthly payment for that would be about $386. So our net payment becomes $1,067.86. And this is, in a nutshell, how to create the lowest payment mortgage available in Canada. Because most interest-only line of credits are issued at 3.5% or 4%, and right now you can get a 5-year fix at 3.19 or 3.09. In early 2000 or mid 2011, I was issuing out these programs at 2.25%. So people were structuring out, $400,000 mortgage where the payment would be $700 a month. So this is a good strategy to implement, but the only issue with it is you're only paying the interest only. But what happens if you wanted to pay down the principal? Well, let's go through that. So let's talk about creating defense. If you lose your job, you became disabled, or just want peace of mind, with a traditional mortgage, something bad goes wrong, this is what's going to happen. You have a normal mortgage, you pay the $1,700 a month, no line of credit is attached to that mortgage, and let's say, for example, you lose your job for 6 months. Well, in a nutshell, over those 6 months, you have to pay that $1,700 a month no matter what. So basically, there's 0 months of mortgage payments covered under a traditional mortgage. But with a readvanceable mortgage, you pay it down for 1 year. The minimum payment in any individual month can be structured to $1,063 a month. But over that 1 year period, your line of credit actually increased to $79.56. Well, you could use your line of credit to pay for the minimum monthly payments in that mortgage. And that means after 1 year, you'd have a 7.5 month defense, or 7.5 months worth of mortgage payments, if you did this, would be covered. At 2 years, again, the minimum payment is still $1,063. Your line of credit, $15,900, and that's 15 months worth of payments covered. Readvanceable for 3 years, again, 22 months. I find it funny when I hear about mortgages out there by certain banks. They talk about, in any given year, we'll give you a 1 month break if you want to from your payment. Well, with a readvanceable, if it's structured properly, in this scenario, the person has 22 months worth of no payments if they chose to. So this is the readvanceable. It allows you to structure the interest-only option, but also allows you to create a significant defense if anything ever goes wrong financially or whatever your position is.